when you look at the precious metal space, the short-term price action for silver is a little bit bearish, but miners and gold are still strong. And when you look at the long-term trends, I mean, they're still holding up, right? So there's mixed signals. The short-term chart for silver to me looks still pretty bearish, but the longer-term trends are supporting it. And so it has, really we just got to let the market work itself out, and we'll see how it digests with the news. I think silver's got a headwind. I think there's kind of a little bit more of people exiting silver and looking towards gold and miners as the play at this point. Yeah, well, I think we're seeing a lot of kind of extremes being reached today. We've got the Middle East obviously creating huge price swings. We can kind of start off with the price of crude oil. We've got a huge move up. Crude oil rallied about just over 12% on the news over the weekend on Sunday night with kind of everything happening. And so we're seeing this giant move up. Now, overall, I think a lot of people got very bullish. They think oil is going to go to the moon. But when we step back and look at the bigger picture of oil, so it's always good to step back and get a feel for what it is doing. And if we were to just draw a really rough line through a lot of these highs through here, you'll notice that the market is in a overall downtrend. We're in a bear market. Oil has been in a bear market for several years. And within bear markets, doesn't matter what the asset class is, you get some of the strongest and the biggest rallies, very short-term explosive moves. And, the last time we had something kind of like this where, bombs are being dropped, it was this big spike over here.
Back in June.
So while this seems like big news, and it is big news, when it comes to price action, this is a very emotional, fear-driven move. It's a strong pop and rally within a downtrend. And typically this will fizzle out within a few trading days. Obviously, unless things escalate and things become a lot more severe, oil could hold up or continue to move higher. But right now, this is a very strong pop based on news, and price really had this huge gap. When we look at oil, it had this massive gap higher. And as we know, most gaps get filled. And so we have a trifecta here. We've got this gap being filled. We're having this huge gap above resistance, above this trend line. And then, of course, it was also a strong news-driven move that happened over the weekend that gives people a little bit of time to kind of let the ideas run wild in their head and become more fearful than they may need to be. And so it created this huge pop, this massive gap up of about 12%. And so now it's fading back down. This was kind of that trifecta of just everything hits all at once on a Monday at the open, and now it's fading back down. So overall, I'm not bullish on oil. In fact, I feel this is very much so a topping tail, a topping sign, a candle on the chart. So we'll have to see how this unfolds. But the big move in oil, I think it's getting a lot of people bullish. To me, it's actually screaming kind of a bearish sign at this point still.
Despite the dramatic rally, the long-term structure of the oil market still tells a more cautious story. Over the past several years, crude oil has largely moved within a broader downward trend. In bear markets, powerful rallies often occur, but they typically represent temporary reactions rather than lasting reversals. These sharp bursts of momentum can happen when traders respond emotionally to breaking headlines. History shows that similar spikes have occurred during previous geopolitical events, including earlier conflicts that briefly drove prices higher before they stabilized again. Unless the situation intensifies dramatically, these rapid surges frequently fade within days as markets return to focusing on supply, demand, and global economic conditions.
Yeah, I mean, this could very easily be right back down testing this 55. Who knows, right? There's a lot at play here. Either we just have to really follow price, let the market tell us which way it wants to go. But right now, it's just a big bounce within a downtrend.
Yeah. Hey, let's look at stonks, S&P or Nasdaq, whatever you'd prefer. Overnight, or at least at the open back on Sunday evening, and then overnight, gold and silver up, crude oil up, stocks, indices down. And then during the American day, at least, as we record this, it's a reversal of all that. What should folks be watching? If, there's always people out there. And I mean, I've been there lots of times too, thinking, okay, stocks are rolling over and what does this mean? And then it bounces right back. What are some key levels to watch here?
Yeah, so we've seen this across the board with pretty much all of the key indices. Now, the S&P 500, the Nasdaq, the Russell, the microcap sector, they've all done the same thing. So we have the news hit. Obviously, war tends to spark fear, which we saw in the VIX today, which looks like a very, very significant top in the VIX. So what that created is everybody to panic and sell stocks. We saw the S&P 500 drop about 1.75% in pre-market. And then, of course, the markets opened and it's rebounded. And it dropped into this blue box. This is a very significant support level. And so when we have a gap on the stock market, gaps tend to get filled. So if it gaps lower, you usually have to expect it's going to fade back up and fill most of that gap. Not only that, but again, very similar to oil, it was news driven. And the S&P 500 fell down to this support level where buyers are naturally going to step in. And because the long-term trend of the stock market, which we can really look at with this 150-day moving average, we're still in a rising tide environment. And so big moves to the downside are still being bought. It's still a buy the dip mentality. Until the major trend reverses to the downside, we're going to keep seeing people buying every dip. And that's what we need to be aware of. Now, the S&P 500 is holding up much better than the Nasdaq. If we look at the Nasdaq, it definitely has a lot more. Let me just clean this chart up a bit. A lot more noise to it, and it has definitely a weaker pattern. So if we were to just look at this kind of support level, the Nasdaq's putting in what looks to be, it could be a major top. There's also this other resistance level kind of right through here, this pivot point on the charts, where we saw the Nasdaq break down below it. It's been ping-ponging around between support and resistance, which is actually seen as a bear flag chart pattern, and it actually points to lower pricing, which means we'd break this critical support level. So the markets are at this very key turning point. And the type of price action you just mentioned, Craig, where price has this huge move down and then it just gets bought right back up. I believe the strength today could carry over for one or two more sessions and see that move back up. There's 1 or 2% upside. The key question is what's going to happen when the S&P 500 and the Nasdaq get up into resistance. Are they going to get slammed again? And then are they going to start to break down? And so very short term wise, we could see a little bit more of a bounce. There's a lot of momentum buying in stocks today. But overall, the bigger picture is very neutral at best. And it looks like it wants to head lower when it comes to the equities markets.
Financial markets are heavily influenced by psychology, especially during times of crisis. When dramatic news emerges over a weekend or overnight, investors often have hours to imagine worst-case scenarios before trading begins. This can create powerful gaps in prices once markets open. In the case of oil, prices jumped sharply above key resistance levels, creating what analysts call a gap move. Historically, many of these gaps eventually get filled as the initial panic subsides. The surge also pushed prices well above established trend lines, another sign that the move may have been driven more by emotion than by structural changes in supply or demand fundamentals.
It's very similar. In fact, the underlying technicals of how we look at cycles and how we look at intermarket analysis across about 12 different assets, we actually have this where we are right now is very similar, almost identical to what we had over here. Now, this was a tariff-driven move. This could be a war-driven move. It really doesn't matter what the news is. Price usually does the same thing. When it starts to break down, it collapses very quickly. But there is a very similar scenario set up in terms of the momentum that is built into this is very similar to the setup. And we could see a very quick unwinding of easy 10 to 20% downside, I think, in the stock market, which would, obviously wreak havoc for most investors who are going to hold through that. That's a pretty significant drop from where we are. That's about that 20% point.
It'd be about a quarter of panic.
Yeah, it'd be interesting to see what some of these drops were. These are about the same distance, right?
Yeah.
The stock market gets about 30% away from the 150-day and then has a 20+% correction. It's been 30% away, and we're on the verge of going for a deeper correction. Now, it's still bullish. The long-term trend is still bullish here. Definitely don't want to go betting on a falling market, because right now we've stepped aside. We're not long and we're not short. We are waiting to see which way the stock market wants to go, because there really isn't much direction. When the daily chart really shows this very well, when we look and we go back to the October highs, If we go back to the October highs over here, the stock market has been going sideways for months. It's been a really crappy market, and money's been flowing into precious metals. We actually have been seeing money move away from the US equities. We've been seeing the Toronto Stock Exchange actually do very well. And this is what happens typically near the end of an economic cycle. When we see the stock market come to a peak, we see commodity rich stock indices start to do very well. The TSX did very well before the 2008 financial crash. It just took off and outperformed. We have emerging markets like EEM. People have been moving overseas, getting into those. So there's definitely money rotating and worried about the US stock market, and they're looking for safety. The one thing I think people need to be aware of is that when they move to these defensive or these alternative plays, there is still a point you need to get out, because when we go through a bear market, you can overlay all the global indices on top of each other. When the stock market the US stock market enters a bear market, all of them correct and sell off dramatically. There is no safe haven. The big question, or the only real difference here, is just before this US stock market goes off a cliff, we tend to see a few other country like indexes do very well. Canada, emerging markets, sometimes it's the DAX, something like that. But these will eventually get pummeled if we do enter a bear market. So it's not something you just park in and you're like, I've picked something that's going to buck the US trend. No, you've picked something that does well until the music comes to an end, and then you really do need to exit equities in general.
The ripple effects of geopolitical events quickly spread into global equity markets. When tensions rise, investors often move capital away from stocks and toward perceived safe haven assets. During the initial reaction, major U.S. indices such as the S&P 500 and Nasdaq dropped sharply in pre-market trading. However, once regular trading began, buyers quickly stepped in. This rebound reflects a long-standing trend in modern markets known as buying the dip. As long as the broader economic cycle remains intact and long-term trends stay positive, many investors see temporary declines as opportunities to accumulate stocks rather than signals of a deeper collapse.
It has been for sure. The precious metal space, it doesn't matter if it's gold, silver, or miners. They are kind of seen as a defensive play in this market condition. They're all the same. They're all moving up. It's just they move up a little bit different from day to day percentage wise. So here's the monthly chart. Looks very strong. If we go drop down to the weekly, as you said, let's take a look here. Again, it's still very strong. All the moving averages here are fanned out nicely. They're all sloping up. And so we're seeing that move. When we move into the daily chart, we definitely, there's been a big movement in the precious metal space where a lot of people have been moving out of maybe overbought metals like silver. Sell your silver at these kind of parabolic prices and move into miners. And so that's what we've seen. I think we've seen a lot of people moving out of silver and moving into miners more or less. And I think that's created quite a big movement in this space. And that's why I think we're seeing mining stocks do very well versus if we take a look at silver, people aren't as excited about silver. They're actually selling silver and moving into miners to try and catch a higher, beta, a bigger play that maybe the fundamentals haven't caught up with the miners themselves. So overall, the space still, I have mixed feelings. Silver, I'm still pretty bearish, but gold, I really do like. If we look at the gold chart and just zoom out, as you and I have talked about this before, there's always like these 20% rallies and then pauses, right?
Yep.
And if we take a look, we go into a big rally and then we have some volatility and it takes months to recover. We have another rally and then it takes months to recover. And we've had another rally. And now the question is, how is this going to react? I mean, we've had more of these. We had another one back over here.
Yep.
And each time we tend to see, gold come up near the highs. And it builds a launch pad and then it breaks out and has a run. And then it eventually has some rallies and it pushes up and then eventually breaks out and it has a really nice run. And so here we're kind of in I think a somewhat of a similar scenario. Volatility is definitely higher than it used to be back over here, but we're back up to these highs. Maybe gold's going to pull back and kind of build some launch pad and create a bit of a bull flag.
Yeah.
And then eventually start to break out and run. And the next target on gold using Fibonacci extension is pointing to about 6,100. So there's still some very good upside, but I'm not a big fan of buying gold right, particularly now. Gold has pushed right up into resistance. It's happened on news, and it's happened inside this giant red bar. And this is called a these are inside bars. You have one big red bar, and all of these are stuck inside it, and it drifts up into resistance. And then at any point, we could actually have a big red bar, and it gets wiped back out. And so that's what I'm worried about, is gold has now drifted up inside of a bearish chart pattern. It's at resistance. We just had news create a big gap that pushed us there. So I feel like it's a little bit of a short-term high. I'm not saying gold's going to crash. I'm saying I think gold is going to fizzle out, and it's going to, I think the short-term gains here are done, and we need potentially a few more weeks. And I mean, I'd like to be bullish on gold. I'd like to see it build out a pattern like this and break out and play another big trade to the upside. But short-term wise, I'm a little bit bearish, because these inside bars can turn into a very big, wipeout in price very quickly. And if for some reason this stuff in the Middle East, for some reason, kind of clears up very quickly, some good news comes about it, that I think some of this was already priced into it, and we could easily see it would give a reason for gold to pull back and for people to sell into it. They're like, oh, the war is over, and it could pull back kind of just like that. The markets move very quickly, and these inside bars are actually very similar to, and I think you and I had pulled this up last time. If we take a look at the bottom chart, the silver chart in 2011, you have a huge red bar down, about the same as what we had just now in 2026. And then it drifts up near the upper end of the range, and then you see another bout of selling. And so it's a very short-term chart pattern that we're looking at here for gold. And even silver, if we look at silver, it's doing the same thing. It is slowly working itself up. And today's price action for silver is pretty bearish. It's an engulfing bearish candle, meaning it's gapped above the previous bar. It's sold off, and it's closing. At this point, it's set to close below it. That is a reversal bar that is actually pointing to a couple more red bars after that. So
often does.
Yeah. So that's kind of where we're at. We have this mixed signal. Silver doesn't look too exciting yet. I think silver needs to build more of a base, right? If it could carve out a rounding formation and pull back and build a bit more of a base, I might be more excited when it starts to break out a bit later, but I think it's still very volatile. It could really ping pong around in here for a while.
While U.S. equities have moved sideways in recent months, other sectors of the global market have begun attracting attention. Commodity-focused markets and emerging economies have seen renewed investment flows. Historically, this type of capital rotation often occurs toward the later stages of economic cycles. Investors start shifting funds into resource-rich markets, including countries with strong commodity sectors. Precious metals have also benefited from this environment. Gold, silver, and mining stocks are increasingly viewed as defensive assets that may hold value during periods of uncertainty. However, history shows that if a true global bear market emerges, even these sectors can eventually experience significant corrections.
When you look at the precious metal space, the short-term price action for silver is a little bit bearish, but miners and gold are still strong. And when you look at the long-term trends, I mean, they're still holding up, right? So there's mixed signals. The short-term chart for silver, to me, looks still pretty bearish, but the longer-term trends are supporting it. And so it has, really we just got to let the market work itself out, and we'll see how it digests with the news. I think silver's got a headwind. I think there's kind of a little bit more of people exiting silver and looking towards gold and miners as the play at this point. The bigger picture for silver, Craig, is the Fibonacci level is pointing to about $140 an ounce for silver. So if silver can base out and build what looks to be a nice chart pattern that I find is a good setup to get long, I'm going to be excited to get long gold and silver, because I think both of them have some really good upside potential. I just want to wait. I'm not about trying to pick a bottom, because short term, it's kind of actually still somewhat in a downtrend, and I don't really want to fight this trend. But once it builds a launch pad, man, there is some good potential in silver we might still have one more parabolic move to the upside. And you don't really want to miss it if there's a good clean setup.
Precious metals remain one of the most closely watched sectors during periods of financial uncertainty. Gold continues to show strong long-term momentum, supported by central bank demand, inflation concerns, and geopolitical instability. Silver, however, has been more volatile. Some investors have recently rotated out of silver and into mining companies, hoping to capture greater upside potential. In the short term, technical signals suggest that silver may still need time to consolidate before its next major move. But the long-term outlook remains intriguing. If the market forms a strong base, analysts believe both gold and silver could eventually experience another powerful rally in the years ahead.